Good morning, everyone, and welcome to the Sirius Report. My name is Ken Shorgen. I'm here with London Paul. And Paul, as we get ready for what is to be expected, the first rate cut by the Fed FOMC since 2020 of all years, there is a lot of interesting thoughts and scuttlebutt going around about how much is going to be done, what the ramifications are going to be, and in reality, what that's going to do for the economy or for the financial system. Anyway, Paul, I want to thank you as always for being a part of this discussion. And
likewise, of course.
This isn't going to be one of those that it's the most important rate cut or Fed decision in X number of years, but it is an important one nonetheless.
Yeah, I mean, at the end of the day, there's a lot of speculation, and we'll come on to this as there always is. Is it going to be 25 basis points, 50 basis points, whatever? And we can, as I say, we'll discuss that in a bit more detail. And also, it depends what Powell says. Now, admittedly, I'm not expecting Powell to say things in very clear, precise language, because the Fed never does, because it's always covering its back, so to speak. But there may be enough of a hint to say, well, it may be 25 basis points tomorrow, but they're hinting in the future, maybe there's another 25 coming, maybe it's more or whatever. So, while it's not necessarily wise to try and place everything based on what the Fed says, it might give a further indication of their thinking. And they may, rather than go to 50 at this point, may just go, well, we'll go 25, because we can always go 25 again very soon. And if they really have to, of course they can have an emergency rate cut. I'm not suggesting they're going to do that. It's just a tool that's available to them.
One of the more fascinating things that has stuck out to me is, one, the Federal Reserve is allegedly supposed to have dozens, if not a few hundred, of the best economists across the board looking at economic data, looking at forecasting and future trends in that. And yet they continue to believe and trust in the manipulated data that comes out regarding GDP, regarding jobs and unemployment, and regarding inflation. Just go back to what it was maybe 2 years ago, before they started raising rates. Oh, we don't see inflation as anything more than transitory, or just, we don't recognize it. And then all of a sudden it's 9% and they're scrambling. I mean, it goes back to many of the instances where analysts and experts are so politicized, you cannot trust the actual information or data that they project to the public, because they're running on a different agenda. And that brings into accordance here, why is Powell suddenly doing it now? The Fed historically has not either cut or raised rates going into an election season. And this is the last FOMC before the election. So that's something interesting on itself. And what are they seeing, especially as the equity markets are at all-time highs, and they've been screaming that there was going to be multiple cuts, upwards of 7 cuts forecast for 2024, and there hasn't been any, and they're still buying stocks like they're going out of style. But the bond market has lost its inversion between the 2 and the 10, and everything is screaming that we've been in recession for a while. So why are they suddenly doing it now versus when recession was imminent?
Well, yeah, it's a great point. I mean, and that's the fundamental issue. I mean, a lot of it's clearly very political, which absolutely buys into your point. Why do it now? I mean, but then at the end of the day, if they cut rates by 0.25% now, so what? That's not really going to make any difference to people's perspective of the election. I mean, no one's going to be able to make a big deal about it from the Trump side of the fence to say, oh, this is an outrageous policy decision. It just doesn't wash. I mean, it's interesting that Congress is actually been screaming in inverted commas to have a 75 basis point cut. So clearly, at the end of the day, we all know, and we've said this many times, as you've just stated, that all the financial economic data is manipulated. And just look at the jobs data. I mean, turned out when they revised it downwards, 818,000. I mean, this is not small numbers. So clearly all the data doesn't marry reality. And therefore the question is reality that bad now compared to the consensus that it isn't? But maybe it's so bad they're starting to go, well, we're going to have to start cutting interest rates. I mean, of course, we can talk about the whole QT, QE thing shortly, why that can be playing into this situation. But also, it doesn't necessarily have to be economic reasons why they're doing it, although there's clearly evidence to support that is a necessity, because the whole economy is predicated on cheap credit. When interest rates are as high as they are, that's a huge problem. But it also, these higher interest rates could now be starting to cause major problems in the financial system, in financial institution. And at the end of the day, the consideration is, well, we have to think of that also. And I always come back to my point that raising interest rates has absolutely nothing to do with combating or taming inflation. It was all to do with supporting the dollar and trying to basically force nations around the world to have to go with a begging bowl to the IMF, particularly the emerging market countries, so to speak, and demand a loan in dollars, so to support the dollar. Of course, this has failed to materialize. And in fact, the absolute reverse has happened also with gold, which should have been 50% and more lower than it was based on hiking interest rates. That's failed to materialize because the dollar treasury complex has been abandoned for gold. Gold is becoming a reserve asset in the minds of many in the global south, and also, of course, countries in Europe like Poland, the Czech Republic, Hungary, etc. So things haven't panned out how they expected with regards to supporting the dollar. So it could be a situation where they're going to have to say, well, we're going to have to abandon the dollar. Also because we're getting to a point when QT, and there's numerous questions, how much of a reality is QT? And as you said before we came on, did QE ever stop? And there's a lot of debate around that. But in reality, they would have to officially get to the point now where QT has to end and QE will have to start. So you can't really have a situation where they have hiked interest rates still and start QE. I mean, bearing in mind, we've already got a huge problem with the budget deficit and the interest payments on the debt. So that's only going to continue to spiral out of control the higher interest rates are. So these are the kind of factors that we have to think about as well. There can be numerous things at play in terms of why the Fed's making this policy decision. Now, of course, I personally think the Fed's politicized. And I'm not just saying it's been politicized during this so-called, Democrat administration, because remember, it's the uniparty, etc. But I mean, I do think there is an element of it being politicized. And the question is, to what extent, if Congress is screaming for 75 basis point cuts, which I really cannot believe would happen tomorrow. I think it's either 25 or 50. But certainly there will be people who will say, well, it's a political decision. But I mean, if that was the case, then they would have already made decisions prior to now. And there's no doubt the US is in recession, and all this data that's all very contradictory with reality. And, this is back to financialization versus the real economy. But I mean, of course, it's an interesting talking point because, the logical argument would be it's the start of a phase of cutting interest rates, irrespective of the illusion of all the data that comes out and this constant belief that somehow the US is going to escape a hard landing. It might not even be a soft landing. it might be a bit of a recession, and who cares? There might be a few million jobs lost in a recession, but it's not a game-changing event for us. But then, you hear noises coming out from institutions who are suggesting that, in fact, this may be worse than a recession. It could be a depression. So when noises come out of financial institutions saying such thing, that's going to factor into the thinking of what's going on in the Fed and why now there is a consideration to lower interest rates, even though, as you rightly say, Ken, it's in the election cycle. It's within a couple of months, and it's the last FOMC meeting before, obviously, the presidential elections.
Yeah, and there's something you mentioned a moment ago as significant. Powell has been vilified by both sides, despite the fact that the Fed in general is political. Powell has been vilified by both sides, yet Yellen and Bernanke were not. Why? Because they were more than happy to buy as many government bonds, treasuries as deficit spending wanted to do. And Powell has attempted at least a little bit, and I don't give him all the credit, but he's attempted at least to have some sort of fiscal responsibility. However, the one thing about Powell, I know that when you take a look at him being trapped in a corner, there's two sides always to the coin. There's monetary policy and there's fiscal policy. And as we know from Congress, especially with this most recent $380 billion deficit in 1 month, no matter what Powell does on the monetary side, it's going to be completely erased by Congress refusing to stop spending and going over budget. At least until, somebody comes in office and is willing to make some changes, and Congress is willing to step up and do their fiscal responsibility, because it doesn't matter. The only thing that is really at play here is, because of the fiscal policy decisions, because of the creation, or I should say the evolution of financialization, anything the Fed does really has, as you mentioned near the beginning, has very little effect on the general economy. This is why they've not been able to deal with price controls, which is one of their mandates. They've not been able to keep the number of retail stores from declaring bankruptcy. They've not been able to stop the housing bubble and the inability of people to be able to afford rent or housing. They haven't been able to stop that. So if they're suddenly wanting to do this now, I'm reminded of a tweet I saw, just an innocuous tweet on Friday by somebody who said, pay attention to the FDIC and see if any banks fail. More than anything, cutting rates is a way to provide liquidity to the financialization, to those banks, maybe just the investment banks, as you mentioned, the BlackRocks, JP Morgan's, Goldman Sachs, etc. Goldman Sachs reported yesterday that they're going to have to take a ton of write-downs on their their commercial banking side. Somebody somewhere is probably hinging on being insolvent, or at least being in some severe deficit. And now it's probably a good time to segue in to the fact that the reverse repo is now pretty much, I think it's down to what, $120 billion, when it was originally up at $2.5 billion or $2.5 trillion. They're almost running completely out of money in this reverse repo for the banks to be able to find liquidity overnight.
Yeah, what I would say with regards to the financial institutions in trouble, I mean, over and above the fact that for me, all the big financial institutions have problems, I would think in the context of this, it's probably more the mid-tier banks again who are in big trouble, and that can cause a huge problem if there's a number of them in serious difficulty. However, you can't rule out a larger institution having those problems. You're absolutely right with regards to the overnight reverse repo agreement, where obviously, it was, as you say, going back 2.5 trillion. I mean, even if you go back to July, okay, there's a spike from tax payments. It got to about 650 billion. I think actually it's about 230 billion now. The last time we looked, based on the evidence that's available. So it's falling sharply, but really 300 billion is often regarded as being the bottom when effectively QT has to kind of end, and it would have to be replaced mathematically with QE, meaning really the Fed can't tighten anymore. Okay, let's just work on the basis the Fed's doing what everyone thinks it's doing, and everything in that regard makes sense. I know, as we said, there are arguments to the contrary, but let's work on the basis it's correct. Well, when you assess that, you would therefore say QE has to start mathematically. And therefore they will have to lower interest rates. And to be honest, lowering interest rates 0.25%, it might make a bit of a difference. Is it going to solve the problems in financial institutions in trouble? Arguably not really. It might help a bit, but is it going to deal with the fundamental problem? I would argue no. Therefore, the argument is they're going to have to cut rates even more and a lot quicker. Well, maybe they do end up having to do an emergency cut. We're in that kind of window, September, October time, when major financial events, if they're going to happen, tend to happen. I mean, okay, Lehman's one of the obvious examples being September. Doesn't mean it will happen, but it's a window where problems tend to rear their head more than in the other time, sort of March time, and that there have been occurrences in the past where that's been a problem. So that's something else to sort of factor into our thinking. But clearly, if they have to resort to QE and on because it's just mathematically has to happen, then they're going to have to slash interest rates. And the other point with regard to fiscal responsibility, it doesn't matter who gets elected in the next government. No one's going to be fiscally responsible because it's going to trash the economy. So they're not going to do that. They're just going to keep on printing and blowing the budget. And the only way to finance it is going to be with money printing. And therefore, the more problems you have in terms of the real economy, and the more you end up having to plug all these gaps, the worse the budget deficit gets. And undoubtedly, that's been going on for 4 years and beyond, then it will get even worse. So therefore, it's just the endless QE to infinity. I mean, the question is, will they spin it and say, no, it's not QE to infinity. It's the not QE nonsense again. They'll probably try to do that, but the question is, at what point do they then have to intervene and support banks again? I mean, there's still those sort of vehicles that are not opaque at all, and we don't really know who's been at that window to seek a kind of bailout in inverted commas. So there are all these things in play as well with respect to what's going on. But I would say in general that it's QT will end. It's an inevitability, and therefore, if that's the case and they have to go to QE, what does that mean in reality? And also, the question is, if financial institutions are in big trouble, so some of them, I'm not saying necessarily they're too big to fail banks and other institutions like them, but if they are, then obviously the question is that they're going to have to slash interest rates, and therefore as well, if they slash interest rates, the question is this going to lead to a sharp hike in the gold price? And if gold keeps, and for argument's sake, I mean, this is not again investment or trading advice, but the logical argument is if they slash interest rates, gold in dollar terms is likely to rise. Is that going to lead to more and more dollars ending up being traded for gold? Does gold become more and more the reserve asset because the US is printing money like there's no tomorrow. And therefore, what does that do to the treasury markets? Does that put more pressure on the Fed just to have to hoover up the debt and just buy everything? And that's the logical argument as well. And that therefore creates more structural weaknesses in the dollar, in the US Treasury complex. And so there are many factors to consider. It's not just a question, we've got an overheating economy, we need to cut interest rates, or a situation where it's the reverse. There's many other factors in play here which are largely not acknowledged in the mainstream and largely not understood elsewhere as to why decisions have to be made. And for me, the argument is it's at least a 25 basis point cut. I know the consensus now is that, and I'm not a big fan of statistical data, but 70% or so probability of a 50% basis point cut. We'll obviously see tomorrow what happens. And therefore, on that basis, just it's a question, okay, having seen the decision that's made, then see how the markets react to that and what it means, more importantly, in a broader situation in the real economy. I'm less interested in financialization, but more what's the impact in the real world, because the real world is consuming this financialization illusion, and that for me is more important than worrying about, well, what's the data, what's the Dow doing or the S&P, etc. Because they're just works of fiction. There is no way in reality the Dow should be at a record high. I'd rather like the DAX. Germany's collapsing in a heap and the DAX is at a record high. This shows how ludicrous financialization is.
Absolutely. And to me, final thoughts here. A quarter point is because they have to do something. They put themselves in a corner, and it's the least potential thing to be called political heading into the election. If they do 50 basis points, that should scream that there is really something intrinsically wrong with both the banking system and the economy. And if they do what Congress, the letter from Congress yesterday, to do 75 basis points, then all I would say is look out below. Anyway, Paul, Paul, I want to thank you as always for being a part of this great discussion.
And likewise.
And to everybody here at the Sirius Report community, thank you for being a part of this as well. Don't forget to like, subscribe, comment, share this with anybody you think is of importance. And until the next time we get together, have a great day.